Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today we're going to be talking about how much the stock market fluctuates, how you can take advantage of those fluctuations to buy great businesses that you love at really undervalued prices, and how you can use that strategy to improve your long-term rate of return. So I think this is going to be a great follow-up video to the previous video that I just released a couple of days ago around how to calculate intrinsic value for a stock. One of the things that I tried to stress in that video is that when we calculate intrinsic value for a stock, that is not the buy price, that is not the purchase price that we want to pay for that business. Typically, we want to try and get as large a margin of safety as possible. In other words, we want to buy it for substantially less than we think the business is actually worth. And fortunately for stock market investors, the stock market is very volatile, and you often don't hear that, good news and volatility in the same sentence. But when you're someone that likes to take advantage of bargain prices or likes to take advantage of really high prices and being able to sell into that sort of greed and buy into the fear, as a lot of people like to put it, volatility can be a very, very good thing for your long-term rate of return. So several decades ago now, Ben Graham came up with this concept of a guy called Mr. Market. And I want to run through some actually stats that I've found online around just how crazy Mr. Market is. So if you don't know who Mr. Market is, which I hope you do by now, but if you don't, essentially Mr. Market is this character that Ben Graham came up with, and he is essentially our business partner when we invest in stocks. So every day Mr. Market comes to us and he offers us a monstrous number of businesses that we can buy as much of that business as we want from him. We can sell as much of the business as we want to him. The only catch is that Mr. Market names the price. And for the most part, Mr. Market is a relatively rational human being. He's not going to sell things to you for dramatic discounts. He's not going to buy things from you for stupidly high prices. But every now and again, Mr. Market can get a little bipolar, and it's our job as investors to unfortunately take advantage of Mr. Market. So Mr. Market can get very fearful, and he will sell businesses to you at a very, very low price, but he will only buy businesses from you at a low price as well. And occasionally, Mr. Market gets very greedy and very optimistic, and he will buy businesses from you at any price you want, and he will sell businesses to you only at very high prices as well. So, fortunately for us, if you know how to calculate intrinsic value and you're confident on those numbers for a business, you do actually get a surprisingly large number of opportunities to buy businesses at a discount to intrinsic value, especially if you're following them really closely. So I want to get into some data just to show you exactly how much the typical stock does fluctuate. The numbers will hopefully surprise you quite a bit and get your hopes up in terms of trying to find some opportunities in the near future. So stick around for this. So I'll put some screenshots up here of this article. This is an article I found on novelinvestor.com, which is a website I've never heard of, but this article is very useful. And it basically shows the difference between the 52-week low, which is the lowest price that shares for a business trade in a given year, versus the 52-week high, which, as the name suggests, is the highest price that shares of that business trade for in a given year. And basically looking at the ranges between those two values. So if we compare the lowest price to the highest price, what's a typical range for your average stock in, say, the S&P 500, which is the largest index of stocks, or the most kind of commonly referenced index of stocks in the US. So in 2017, which is where a lot of this data is coming from, the average fluctuation for a stock, the average difference between the 52-week low and the 52-week high is over 50%. It's 56.5%. And that fluctuation is massive. I heard a lecture the other day where people were comparing auction-driven stock markets to something like the real estate market, which is a little bit more slow in terms of price changes. And they gave this analogy that, if you were able to sit down with a real estate broker every single day, let's say you took that real estate broker out to breakfast, and you every single day, your only purpose for taking him out to breakfast was to ask him what he thought your house was worth. And let's say you owned $1 million home, and basically every single day you'd go out for breakfast with the broker, and he would say, your house is still worth $1 million. If you fast forward a few months down the track, maybe he might say, your house is worth $1,050,000, something like that. Maybe a 5% increase in price. But the range over a 12-month period wouldn't be very significant. It might range from $950,000 to maybe $1,050,000. So, $100,000 difference kind of either side, 5% either side. And that is a very, very tight range. And that's quite typical of several asset classes. You see that in farms, you see that in real estate. Several asset classes out there, we don't see huge fluctuations in price. But all of a sudden, when you come to the stock market and you have all of these factors which make people, for the most part, very short-term focused and far more short-term focused than they should be, you suddenly get these wild fluctuations in prices, which for the long-term value investor is a phenomenal advantage. For a price of a business to fluctuate 50% in a year from the lowest to the highest is just ridiculous. There's no way that the underlying cash flows of that business are going to change for the long term by that amount in a 1 year period. That may happen for a given business. One business may go through the floor or through the roof in terms of how the actual business is performing. But if you're taking a group of the 500 largest stocks in America, the chances of, on average, a stock having its intrinsic value changed by 50% is just ludicrous. It doesn't make any sense at all. And even the least volatile stocks in this study move around a substantial amount. Even first place in terms of the lowest difference between 52-week low and 52-week high was a company called FMC Technologies, and it still moved around 9%. So by stock market terms, that is very, very small. But by the time we get even just out of the top 10 in terms of the lowest volatility out of these 500, we're still talking about a 20% price difference. Compare that to our real estate example, where we only had a 5 or 10% fluctuation in price. Even the lowest of the low in terms of volatility in the S&P 500 in 2017, around 10th place out of the top 500, is still moving around like 20%. And by the time we go down to the other end of the spectrum and we're looking at, the most volatile 10 or 20 companies, we're talking well north of 100% changes in price. And to be honest, those are probably businesses that have had some genuine major changes to their intrinsic value. Cash flows have turned out to be not what they expect, either much better or much worse. And, some of those price changes may well be justified. But what I'm trying to say here is that for the average stock to fluctuate 50%, it doesn't make any sense. Intrinsic value doesn't change by 50% in a year for the average business. That is simply short-term fluctuations in the stock market, and those are things that we should be taking advantage of as much as we possibly can. So there you have it. That's my thoughts on stock market volatility and why it can be amazing for your returns if you're confident in terms of calculating intrinsic value and buying at a deep discount to that. So I hope you enjoyed the video. I'm going to leave the study that I was referring to linked down in the description if you want to check that out. And this is a really important lesson. So if you didn't get the concept ingrained in your brain from me in the video just then, I'm going to leave you with a short clip from Warren Buffett talking about exactly the same concept. And if I can't drill it into you, I am hoping that Warren Buffett can. So I hope you enjoyed the video. Here's a clip from Warren. Otherwise, I will see you in the next one. Cheers.
That business. The stock market is there to serve you and not to instruct you. And that's a key to owning a good business and getting rid of the risk that would otherwise exist in the market. You mentioned volatility. It doesn't make any difference to us whether the volatility of the stock market average is a 0.5% a day or 1/4% of a day or 5% a day. In fact, we'd make a lot more money if volatility was higher because it would create more mistakes in the market. So volatility is a huge plus to the real investor. Ben Graham used the example of Mr. Market, which is we've used it. I've copied it in the report. I copy from all the good writers. And Ben said, just imagine that when you buy a stock that in effect, you've bought into a business where you have this obliging partner who comes around every day and offers you a price at which you'll either buy or sell. And the price is identical. And no one ever gets that in a private business where daily you get a buy-sell offer by a party. But in the stock market, you get it. That's a huge advantage. And it's a bigger advantage if this partner of yours is a heavy drinking manic depressive. I mean, the crazier he is, the more money you're going to make.